Alright, my people, welcome to a quick technical Thursday. Today I'm going to be teaching you how to identify higher probability market conditions. Now, this is going to vary dependent on what strategy you're trading, but this is a general characteristic that you should be looking for before you come to actually risk your capital in a live market. Let's hop right into the charts. Now, what defines a high probability market condition? Now, like I previously said, it's going to depend on what kind of strategy you're trading, but the majority of traders will benefit from higher volume periods. And not a lot of traders, to my knowledge, really like the consolidative periods where price is wicking because, again, it just makes it that much more difficult to trade. The market is always shifting and there's not exact defined characteristics, but it's a general sort of sentiment that you should be paying attention to. We all know about uptrends, downtrends, and consolidated periods. But do you know that there's multiple types of trends? Now, just before we get into the live market example, let me show you what I mean by this. So again, obviously, I'm sure you all know what a uptrend is when price is making higher highs and higher lows continuously. So this is an uptrend. But did you know that this is also an uptrend? The same sort of formation, price is still continuously making higher highs and higher lows. But obviously, this price action is a lot less clean and it's a lot more difficult to trade because you have minor swing lows and minor swing highs within this. And it just makes it more confusing price action to look at. So when I'm talking about clean price action, I'm referring to clean swing highs and clean swing lows, and not choppiness like this. Now, I personally like to split my market conditions into one of three categories. We have category A, category B, and category C. Now, category A refers to nice trending markets. This is when you have push phases and exhaustions. So typically speaking, this is where a lot of traders eat. This is where a lot of traders make their profit. And it's when you have a market that is pushing in one direction, is forming a downtrend right here, for example. So you have the pushing days, and then you have the exhaustion days and the pullbacks. The pushing days, the exhaustion days, the pullbacks. And it's like a weekly cycle that will kind of take place for a month, 2 months, however long the trend is. But this is your most typical kind of market condition, but it's not like 24/7 impulsive moves. This is market condition A. Now, market condition B would be these sort of movements right here. These typically tend to be 2-3 week movements. It depends on what you're trading and what time frame, etc. But this is when you get the impulsive movements, the impulsive trending markets. This doesn't allow for any pullbacks. If you're a tradesman trader, if you're a pullback trader, you typically won't find any good entries here. You won't have a good trading period during these sort of movements. I personally really like them. They're great for like continuation movements for breakout traders. These are your like optimum kind of trade conditions. But again, this is what I'm talking about. It varies. You may prefer condition A. Condition A, when you're getting pullbacks and retracements, may be absolutely great for your strategy. And condition B may be a no trading period for you. And again, this is what I'm saying when it differs. But both of these, in my opinion, are high probability markets. They're strong sentiment, a strong condition. Price action isn't messing about. Now, when do we get into the bad market conditions? Well, for me, the bad trading conditions are, again, the accumulated sideways movements. So the period in between. Now, granted, the market is not always going to be trending. We're not always going to be pushing. There needs to be extended accumulation phases. And again, dependent on what instrument you're trading, whether it's the indices or Forex or whatever, your accumulation period, the timing of it is going to differ. But whenever you tend to see price action like this for like a week or two more extended, to me, those are terrible, terrible market conditions. And I will not trade a market that looks like this until I have a clear breakout of structure. So if anything, it would actually be here on this third candle, because then when you would start to look at the market again and be like, okay, cool, we may be doing something. So again, let's take a look at some more examples. This right here would be your market condition B. Again, notice large impulsive movements. Bear in mind, we're here on the daily time frame. So this is like 2, maybe almost 3 weeks of clean trending price action, no pullbacks, and just large movements. Very, very nice. This right here, this entire period right here, I would actually consider this kind of a price action in terms of we're pushing and accumulating. Granted, this is GJ, and this is another factor you need to consider. Your good price action on your clean trending market may look different because, again, it's a unique characteristic. It's personalized to the instrument you're trading. Right now, I'm on GBP JPY. If I was on US 30, this market condition or market condition A would look entirely different. Again, same characteristics. You're still looking for the push phases, the exhaustions. But I'm saying it's going to look different dependent on what you're trading. GJ is obviously a Forex pair. It's a minor. It accumulates a lot longer, which is why I'm kind of disregarding this. But yeah, this would be your A market condition. Again, this is a beautiful, I would say this is like an A or a B because you're getting nice push phases and accumulations as well. And then right here, this is another example of like a C market condition. You see this, you come onto the market, you see prices failing to break structural highs, failing to break structural lows. You've got large wicks, you've got small bodies. All of this to you should be screaming bad price action, don't trade, don't trade. That's it. Now, again, learning to identify market conditions is something you'll get better at through time. Through experience in the markets, you'll get better at. You'll just have a gut feeling, an instinct. It's your subconscious brain. You'll start to pick up certain patterns. But if you're being honest with yourself and you come onto the markets and you head out to a daily time frame, you start your higher time frame analysis, you can visually see what the market is doing. 9 times out of 10, if you head to the daily time frame, it should be very apparent to you, should be very obvious, uptrend, downtrend, buys or sells. If you have to think, if you have to hesitate, you have to like zoom in and start looking, is this a high, is this a low? Chances are the price action isn't clean and you're trying to force a trade that isn't there. So just remember, your initial thought should be instant. Your initial buys should be quick. If it's not, you're either just hesitating for whatever reason or you're trying to force something that is not there. And again, this is something that you'll pick up through experience. A great book about this is actually called Blink by Malcolm Gladwell. Highly, highly recommend it. So what do you do during the bad trading periods, the bad market conditions when it's low probability? What can you do? Can you still trade? Well, technically, yes. You may come across bad market conditions and you may scale into a smaller time frame and still find a valid trading opportunity. And whether or not you choose to take that is entirely up to you and your risk tolerance. But from my personal experience, taking trades in low probability market conditions is obviously going to result in more losses. And I don't know about you guys, but I don't want to add more losses to my track record. I'd rather stay out of the market and wait for the higher probability trading setups to occur so I can then risk my capital that I still have because I'm not going to be in drawdown from taking the trades in the bad conditions. And then that's how you actually improve your win rate and actually get better overall as a trader. Very, very easy concept. Again, main kind of takeaways for you guys to look at. Identify the trend, uptrend, downtrend, consolidation. Very, very easy. All you guys should know how to do that. Second step is identify the behavior of that trend. Is it impulsive? Is it retracing? Is it giving you pullbacks? Is it accumulating? How is price moving in the direction it is moving? And is that right for your system? If you're a continuation trader, you want high volume. If you're a pullback trader, you want retracements. If you're scalping, maybe you don't really care. You see what I'm saying? So you need to correlate it to the system you're trading. But remember that not every day is a trading day. And like I said, if you're hesitating initially, your trade is not there. See you guys in the next video. Run the outro.